Investors woke up to a bloodbath on the Indian stock market on February 28, 2025. Both the Sensex and Nifty, the benchmark indices of the Bombay Stock Exchange and National Stock Exchange respectively, witnessed a freefall, mirroring a global risk-off sentiment. The Sensex plummeted by a staggering 1,400 points, closing at 73,602.21. This marked a significant 15% decline from its peak. The Nifty fared no better, plunging below the crucial 22,200 mark to close at 22,217.50. This losing streak is the longest the Nifty has witnessed since 1996. The market capitalization of BSE-listed companies eroded by a massive 5.8 lakh crore rupees, ending the day at 387.3 lakh crore rupees. This wasn't just a single-day phenomenon. This marked the culmination of a 5-month-long losing streak for the Nifty 50, the longest since 1996. It was also the second worst monthly decline for the index since its inception in July 1990. The severity of the situation was evident in the broader market as well. The Nifty Mid-Cap 100 index tumbled 3.4% to 47,485 points, a steep 22% down from its peak. The Nifty Small Cap 100 index wasn't spared either, dropping 3.55% to 14,617 points, reflecting a 26% decline from its peak. One of the primary factors behind this market rout was the escalating global trade tensions. The United States, under the leadership of President Donald Trump, announced fresh tariffs on imports from China and other countries. These new tariffs, targeting a wide range of Chinese products, have sent shockwaves across global markets. The move is seen as a major escalation in the ongoing trade war between the two economic giants. The impact of these tariffs extends far beyond just China and the US. Tariffs on Mexico and Canada are set to go into effect on March 4th. Additional tariffs on China will raise existing tariffs by 10%. There is even a threat of a 25% tariff on imports from the European Union. These protectionist measures have raised concerns about a global economic slowdown. Investors fear that rising tariffs will lead to higher prices for consumers, ultimately hurting demand and corporate profits. This uncertainty has fueled a flight to safety, with investors pulling out of riskier assets like stocks and moving towards safer havens like gold. Adding to the woes of the Indian stock market is the relentless outflow of foreign funds. Foreign portfolio investors, who have been net sellers in the Indian market since October 2024, continued their selling spree. This exodus of foreign capital is a major concern as it puts further downward pressure on stock prices. The uncertainty surrounding global trade and the strengthening US dollar have made Indian assets less attractive to foreign investors. Data from depositories show that foreign portfolio investors have pulled out a staggering 3.11 lakh crore rupees from Indian exchanges over the past 5 months, from October 2024 to February 2025. This trend continued on February 28, with foreign portfolio investors selling equities worth 556.56 crore rupees. This steady outflow of foreign funds is a clear indication of the nervousness prevailing among foreign investors about the Indian market. The market meltdown on February 28 was broad-based, with selling pressure across all sectors. However, some sectors were hit harder than others. The IT sector, a bellwether of the Indian economy, witnessed a sharp decline, with the Nifty IT index plunging nearly 4%. Heavyweights like Tech Mahindra, Infosys, TCS and HCL Tech were among the top losers, reflecting concerns about the impact of the US-China trade war on the IT services industry. The auto sector, another key sector of the Indian economy, also felt the heat, with the Nifty Auto Index slipping nearly 3%. Maruti Suzuki and Ashok Leyland were among the prominent losers in the sector. This decline can be attributed to a combination of factors including rising input costs, slowing demand, and the uncertainties surrounding the transition to electric vehicles. Adding to the overall bearish sentiment was the nervousness ahead of the release of key economic data, including the country's GDP growth figures. A weakening Indian rupee, which hit a record low of 87.95 against the US dollar, further added to the worries. The rupee's fall makes imports costlier, potentially fueling inflation and hurting corporate earnings.